It's going to make you think when a guy who's swimming in billions starts talking about a market crash, right?
Yeah.
It definitely gets your attention. And that's exactly what we're seeing with Richie Riskoff, the
Yeah.
billionaire investor. He's put out a warning about a pretty serious market correction, talking like 20% drop or even more. And I know, right? Now, obviously, most of us aren't dealing with those kinds of numbers, but here's the thing. Understanding what's driving his thinking, and even more importantly, what he's actually doing about it. That can give us regular folks a real advantage when it comes to making our own investment decisions.
Absolutely. It's not about copying everything these financial giants do,
Yeah.
but about getting that insight,
Mm.
understanding their logic. So in this deep dive, we're really digging into a recent article that lays out Richie's concerns and his strategy. And get this, he's putting a lot of his money into what they call high-yield assets.
Exactly. We're not trying to become Richie Riskoff overnight, but we do want to get a peek inside that billionaire brain, figure out what makes him tick. Why is he so worried about a downturn? What does high yield even mean in this context? And most importantly, what can we actually take away from all of this and apply to our own portfolios, no matter how big or small?
Right. Let's break it down.
All right. So first things first. What's got Richie so spooked? Let's talk about those warning signs.
Well, the article points to a bunch of factors, kind of like a perfect storm of economic worries. First off, you've got inflation that just won't quit. It's like a stubborn house guest that refuses to leave.
Yeah.
They've been trying to cool things down, but prices are still climbing higher than anyone expected.
Yeah, it's definitely not going away quietly. And then on top of that, you've got those high interest rates hitting everyone, right?
Exactly. And those high rates, they really start to squeeze everyone. Consumers are feeling it, and businesses are facing higher borrowing costs, which cuts into their profits.
That's
A chain reaction.
For sure. Higher rates have a ripple effect across the whole economy. And let's be real. The global situation isn't exactly helping things, is it?
Nope, not at all. The article talks about geopolitical instability, and you don't have to look far to see all the tension points around the world.
Yeah.
All that uncertainty definitely feeds into the economic jitters. But you know what? Maybe the biggest thing that's got Richie worried?
What's it at?
Tech valuations.
Ah, yes, tech stocks. Still a big chunk of a lot of people's portfolios. So what's Richie's take on all that?
Well, he thinks a lot of those tech valuations are way too high. The article even compares it to, like, your grandma's Beanie Baby collection.
Ew.
Remember back when everyone thought those things were going to fund their retirement?
Oh, yeah. The good old days.
Right. Well, the point is, a lot of those tech companies, their current prices aren't really backed up by how they're actually performing. And if the market sentiment shifts, watch out, things could drop pretty fast. And it's not just about their earnings right now. It's about those future growth expectations that are baked into the price. And Richie probably thinks those expectations are way too optimistic given all the economic headwinds we're facing. So yeah, those tech companies could be in for a rude awakening.
Ouch, Beanie Babies. That's a pretty stark image.
Oh.
Makes you think about all those investments that are driven by hype rather than, actual value.
Yeah.
So it sounds like Richie's bracing for impact. But here's the interesting part. The article says he's not hitting the panic button and selling everything. So what is he doing?
That's where things get interesting. He's actually increasing his holdings in what they call high-yield assets.
Okay.
So he's shifting gears,
Yeah.
moving away from chasing growth,
Yeah.
focusing more on generating income and protecting what he's already got,
Yeah.
especially since he thinks the market's going to be a lot more volatile.
So he's playing defense.
Exactly.
But let's break this down. When we talk about high yield, what are we actually talking about? What kinds of assets are we looking at? The article mentions some specific categories.
All right, they do. So first, you've got utilities. Those are usually pretty stable, and they often pay consistent dividends. Then you've got REITs, real estate investment trusts. These guys make money from owning properties.
Yeah.
Like think apartment buildings, warehouses, even data centers. They could be a good bet because people always need a place to live, work, or store their data.
Makes sense. What else?
Then there's BDCs, business development companies. They invest in smaller companies, often private ones, and they pass those profits along to their shareholders. And sometimes they even pay out special dividends if things go really well.
Huh. Interesting. And what was that last one?
Oh, yeah, dividend aristocrats.
Yeah.
These are companies that have a really impressive track record of paying and increasing their dividends for a long time. I think decades. And actually, the article even throws out the possibility of mortgage REITs, too.
Mortgage REITs. Those are the ones backed by real estate loans, right?
Exactly.
Okay, so that's quite a mix of income-generating investments. And it ties into another interesting point the article makes about cash is no longer trash. What's that all about?
Yeah, so for years, interest rates were super low. practically zero. So holding on to cash wasn't really doing much for you. It made more sense to take risks and invest in things that could potentially grow faster. But now that interest rates have gone up, holding cash is a little more appealing. You can actually earn something on it. But Richie's big move into high-yield assets suggests he thinks there's an even better opportunity out there. He sees a chance to lock in some serious income streams from these specific sectors. And you know what? He might even end up outperforming both those low-yield savings accounts and the overall market, especially if his hunch about a correction turns out to be right.
So he's thinking ahead, playing the long game.
Exactly.
Okay, so we've talked about what Rishi's worried about and how he's responding, but let's get down to brass tacks. What makes these high-yield assets so attractive right now? Why is he making this move?
Well, there are a few reasons. First off, it looks like the Fed might be easing up on those interest rate hikes.
Oh, really?
Yeah. And that's usually good news for income-generating assets because, they've been kind of sensitive to those rising rates.
Right, right. And speaking of rates, what about those juicy U.S. Treasury yields? Everyone's talking about those 4 to 5% returns.
Yeah, but there's a catch. They don't really have much room to grow. And they carry what's called duration risk. It's kind of complicated, but basically if you buy a long-term bond and then newer bonds come out with higher rates, your old bond becomes less valuable and its price drops.
Yeah.
It's like buying last year's smartphone model. It still works, but it's not the latest and greatest anymore.
So you're stuck with that older tech.
Right, exactly. Now, on the other hand, you've got those dividend-paying stocks in the sectors we talked about. They're already offering yields in the 6 to 8% range. And if interest rates eventually go down, which is possible, their prices could actually go up. So you could win on both sides. You get that nice income stream now and maybe even some capital depreciation later.
So it's like a double whammy.
Exactly. It's a different approach from chasing those high-growth stocks, the ones that promise to skyrocket overnight.
Right, right. And the article actually makes a point of comparing Richie's approach to those growth bros and the meme stock crowd.
Yeah, it does. It's like they're playing different games entirely. Some people are all about those quick gains and risky bets. But Richie's taking a much more conservative approach. He's focused on stability and protecting his wealth, which, makes sense, especially if you think a storm's brewing.
Right, so he's battening down the hatches.
Exactly. He's not chasing the latest fad. He's building a portfolio that can weather any storm.
Okay, so we're getting a pretty clear picture of Richie's concerns and how he's reacting. But here's the million-dollar question. How can we regular folks take these insights and apply them to our own financial lives? We're not exactly billionaires. The article talks about thinking like a billionaire. What does that even mean? What are the key principles we can learn from?
Well, the article highlights 3 really important principles that anyone can use. The first one is accept volatility. It's like that old saying, you can't avoid the rain. So yeah, market corrections, they're going to happen. They're a natural part of the economic cycle. It's not the end of the world. And, smart investors, they actually use those corrections to their advantage. They shift their money into safer assets. It's a calculated move, not a panic attack.
Right, right. So it's about being prepared for the ups and downs, not freaking out when things get bumpy.
Exactly. Be like a surfer, Ride the waves. Don't get wiped out.
I like that analogy. Okay, so what's principle number 2?
Look for yield with staying power. A high dividend yield can be tempting, but you got to make sure it's coming from a solid company, one that can actually keep paying those dividends over the long haul. The article calls out those so-called Ponzi dividends. Those super high yields that are too good to be true. They're usually a red flag because they're probably not sustainable, and if the company cuts the dividend, the stock price could tank.
So it's like a house of cards.
Exactly. It looks impressive until it all comes crashing down, and you definitely don't want to be caught holding the bag.
Nope. Okay, so what's the third principle?
Don't put all your eggs in one basket. Diversify your income streams. Don't just focus on one high-yield sector or asset class. Spread your investments around. Different sectors, different risk levels, even different payout schedules. That way, if one area takes a hit, your whole portfolio isn't sunk. And, the article even mentions thinking about the tax implications of your investments.
Right. Taxes are always a factor.
Exactly. So, yeah, diversification is key. It's like having a financial safety net.
Okay. These are some really solid principles that anyone can use regardless of how much money they have. So let's get specific now. The article dives into some high-yield investments that seem to fit with Richie's strategy. Let's start with Enterprise Products Partners, ticker symbol EPD. What can you tell us about them?
So EPD is in the energy infrastructure business. They mainly deal with pipelines and natural gas processing. And right now they're offering a yield of around 7.3%. Yeah, and what's interesting about them is that their cash flow is pretty stable. They make money by transporting energy. So their revenue isn't directly tied to the ups and downs of oil and gas prices. They've also got a long history of paying consistent dividends to their shareholders, like over 2 decades.
Wow, that's impressive, eh?
Yeah. And it looks like their dividend is well covered by their earnings, which means they can probably keep paying it even if things get tough. And here's a bonus. They're structured as a master limited partnership, or MLP, which can offer some tax advantages.
Oh, that's always nice.
Right. So if we think about why Ritchie might like them, it makes sense. They've got that steady cash flow.
Yeah.
They tend to be less volatile than the overall market. And historically, they've held up pretty well during recessions.
Right.
Plus, those tax benefits probably don't hurt either.
Right. Makes sense. Okay, so next on the list, we've got Realty Income, ticker symbol O. They're currently yielding around 5.9%. They're a REIT, right?
They are. They focus on retail and commercial real estate. And get this, they're known as the monthly dividend company.
Monthly dividends. That's got to be nice for income investors.
Oh, yeah. It definitely is. And their portfolio is pretty diverse. They own properties that are leased to tenants in those essential retail sectors. Like think pharmacies, dollar stores, convenience stores. Those businesses tend to do pretty well no matter what's going on in the economy.
Yeah, people always need their essentials.
Exactly. So they've got that dependable tenant base, plus a long track record of consistent dividend increases. They're a classic choice for income-focused investors. And I bet Ritchie likes them because of that steady monthly income and their resilience even during recessions.
Yeah, the monthly payout is definitely a big plus, and the power of compounding over time. That's huge.
Okay.
Next up, we've got Main Street Capital, ticker symbol MAIN. They're yielding around 6.8%. What's their story?
So they're a BDC, a business development company, and they mainly invest in smaller companies, often private ones. They make money by lending them money or taking an equity stake, and then they share those profits with their shareholders. And sometimes they even pay out those special dividends if their portfolio companies do really well.
So it's a way to get exposure to those private companies that we normally wouldn't be able to invest in.
Exactly. And for Ritchie, that's probably a big draw. It's like getting private equity-like returns, but with the liquidity of a publicly traded stock.
Yeah.
You can buy and sell it easily, and you don't need to be a millionaire to invest.
Right. That makes sense. Okay, now this next one has a pretty eye-popping yield. Starwood Property Trust, ticker symbol STWD. They're yielding over 10%, but the article does mention that they might be a bit riskier.
Yeah, that's true. They're on mortgage REITs, so they're more exposed to fluctuations in interest rates and the overall health of the credit markets. But here's the thing. They're run by Barry Sternlicht. He's a big name in real estate and hospitality. He founded W Hotels.
Oh, wow.
Yeah, so he's got a pretty impressive track record. And STWD has a more diversified portfolio than some other mortgage REITs. They own a mix of commercial real estate loans and actual properties. And their management team has been through a lot of interest rate cycles, so they've seen it all.
So they've got experience on their side.
Exactly. The high yield comes with higher risk, but Ritchie might be betting on their ability to navigate the market and make smart lending decisions. They've got deep pockets, and they're not afraid to take calculated risks.
So it's a high-risk, high-reward kind of play.
Exactly, but with a seasoned captain at the helm.
Okay. And last but not least, we've got Brookfield Infrastructure Partners, ticker symbol BIP. They're yielding around 5.4%. They're a global infrastructure play, right?
That's right. They own and operate all sorts of essential infrastructure assets around the world. Think data centers, toll roads, transportation networks, utility companies, the stuff that keeps the world running. And a lot of their contracts are long-term and generate pretty predictable cash flow.
Sounds stable.
It is.
Yeah.
And here's the kicker. A lot of those contracts have built-in inflation adjustments. So they're kind of like a hedge against rising prices.
Oh, that's smart.
Yeah, it is. And for a big investor like Ritchie, infrastructure offers a lot of benefits. It's like a hedge against economic uncertainty. It tends to be consistently profitable. And it provides that inflation protection, which is really valuable right now.
For sure. Okay, so we've covered a lot of ground here, but the article also mentions a few bonus picks, like covered call ETFs, traditional utilities like Duke Energy, and dividend aristocrats like Johnson & Johnson. Why include those?
Well, they're basically additional ways to generate income and diversify your portfolio. Spread the risk around covered call ETFs, make money by selling options contracts. And utilities, they're usually considered safe and stable investments that pay consistent dividends. And then you've got those dividend aristocrats. Those are companies that have increased their dividends for like a really long time, which shows they're financially strong and committed to rewarding their shareholders.
Right. Right. So when you step back and look at Richie's strategy and all these suggestions, the big takeaway seems to be moving away from those risky growth stocks and building a portfolio that can generate steady income and one that can handle those market downturns that everyone's talking about.
Exactly. It's not about predicting the future perfectly. It's about being prepared for whatever comes your way, locking in those good yields while you can, and making sure your income streams are diversified.
So it's like building a financial fortress.
Exactly.
The article ends with a really important message for our listeners. It reminds us that we don't have to agree with everything a billionaire investor does, but watching what they do and understanding their reasoning can give us valuable clues for our own financial planning. We can learn from the best.
Absolutely. And the article really stresses that we don't just have to survive market corrections, we can actually use them to our advantage. By focusing on value and income,
Yeah.
the fundamentals, we can come out ahead.
So it's about being proactive, not reactive.
Exactly. And the key takeaways are pretty simple. Move away from those flashy trends, invest in solid businesses, secure those reliable income streams, and diversify.
So basically think and act like a pro, even if our bank accounts don't look quite the same.
Right. It's about adopting that same mindset, that calm and patient approach, building a portfolio that generates consistent income and helps you reach your goals regardless of what the market's doing day to day.
Okay, so to sum it all up, the TLDR version for our listeners, expect more market volatility. Consider moving some of your money into high-yield investments with strong fundamentals. Focus on consistent cash flow and the magic of compounding. Don't let those short-term market swings freak you out, and always invest with a long-term perspective. That's how the pros do it.
It all boils down to this. How do these potential changes in the market and this renewed interest in income-generating assets fit with your own financial goals, your risk tolerance, and your investment timeline? What are you comfortable with? What makes sense for your situation? With all this talk about a potential market shift and Richie risk-off strategy, what are you curious about? What income-generating assets might you want to explore further?
That's a great question for everyone to think about. Thanks for diving into this with us today.
Absolutely. It's been a pleasure.
All right, folks. That's it for this deep dive. Catch you next time.
Take care.
And remember, do your own research before making any investment decisions.
Always good advice.